Hello, Finamisers. Welcome to another Finamise Live. My name's Russell. I'm an analyst here at Finamise, and I'm happy to host today's event on gaining an edge beyond ETFs with our partner, Freck. First, we have some housekeeping to run through. As you're coming in, please fill out the poll. Feel free to introduce yourself in the chat, tell us where you're tuning in from, and remember to switch to all attendees so everyone can see your messages. This is going to be a 30-minute discussion followed by a 15-minute audience Q&A. Please use the Q&A box to ask a question, and if you see a question you like, upvote it so it moves to the top. That way we can get through the most upvoted questions first. Okay, so let's kick this off. Our event partner today is Freck. It's an investment platform making sophisticated investing super simple and accessible. Freck's mission is to give everyone access to the same tools used by the ultra-wealthy to build long-term wealth. Many advanced wealth creation strategies, such as direct indexing, are now ready for mass adoption due to technological advances in financial tooling. Freck was founded in 2021 and is based out of San Francisco. And today we're excited to welcome Mo Al-Adam, founder at Freck. Previously, he was the first advisor at Instacart, founder of TwitVid, and a product leader at Twitter. Mo, great to have you here. How are you doing today?
Very good to be here. Yeah, thanks for having me.
Absolute pleasure. Okay, Finamisers, let's dive in. Mo, over to you.
Awesome. Yeah, I'm excited to be here to talk to you all about direct indexing and how it can save you on taxes and reduce your tax liability. So yeah, like maybe we can start with I mean, maybe you've Russell, you've already introduced me, but just to quickly recap, I'm the founder and CEO of the company. We've been working on Freck for the past 2 years, and we have really taken a first principle approach to understanding direct indexing from the ground up, and we're excited to share these learnings and sort of like the science behind direct indexing with you directly today. So the way we want to talk about direct indexing is we want to sort of like first understand ETFs and how they became the kind of the most popular tax-advantaged vehicle for passive investing, and what direct indexing does to kind of beat that tax advantage and make it better. And then we're gonna sort of like talk through the mechanics of direct indexing, how it works, tax loss harvesting. We're gonna give a quick demo of what a direct indexing account looks like, and then sort of like talk about some of the gotchas of direct indexing, and then transition to the Q&A. Of course, you're welcome to leave your questions and answers in the Zoom chat as well. And then we'll get to them at the end or throughout the presentation. Okay, so like the vehicle of choice for passive investing used to be the mutual fund. This is back in the 70s and 80s and even to the mid 90s. And when ETFs came along in the mid 90s, it was a real big sort of like moment, right? Because it made passive investing tax advantaged in a big way, right? And then, sort of like fast forward till today, and you can think of direct indexing as the evolution of that. On the same path, we're trying to make passive investing even more tax advantaged, and it adds another sort of like perk to investing as well, in that it adds this potential to personalize your direct index. Today, we're going to focus a lot more on the tax advantage element of direct indexing, and perhaps we can touch on the personalization piece, but most of it is trying to understand from first principles how it's more tax advantaged and how you can sort of like sort of materialize that in your own personal financial lives. So to understand ETF tax advantage, it's good to know that both ETFs and mutual funds pass down capital gain distributions to their owners, right? And the chart on the right kind of shows you like in gray, a mutual fund versus an ETF in blue, and how the black dots represent moments in time where you had a capital gain distribution, where you had to pay taxes by just holding on to the fund, right? ETFs are way more tax efficient because they do something that is called in-kind redemptions, right? So if a fund needs to rebalance or sort of like honor some redemptions, it does not sort of like pass along those cap gains down to the fund owner, right? It does create and redeem shares of the ETF and sort of like exchanges baskets of stocks for those shares without that sort of like mechanic passing down to you as a fund owner, right? And which is why you sort of like you're kind of shielded from cap gain distributions with an ETF. And it helps to kind of visualize this, and I know this is going to look a little scary, but I'm going to walk through it. But this is a 5-year time horizon for owning a mutual fund where you sell at the end versus owning an ETF where you sell at the end. And this is really key to understanding sort of like, the tax advantage of ETFs and how direct indexing kind of also plays a big role. So let's look at a mutual fund in green here. So imagine you bought a mutual fund at the very beginning of time for $100 and it's growing 10% a year, right? So by the end of year one, it's worth 110. But what happens is you end up getting passed down the $10 in gains, right? So you end up like saying, okay, well, I'm going to pay taxes on the $10, so I'm going to pay $3, assuming a 30% tax rate. And the additional $7, you're buying more shares of the mutual fund, right? And this happens year after year after year until at the end, very end, you're trying to sell your assets, right? And you end up, owning some taxes at the end, but you're kind of current on your taxes. You've paid taxes in year 1s and 2 and 3 and 4 up to year 5. And when you do that big sell event at the end of year 5, it's not this massive tax bill that you've incurred, right? You're kind of current on your taxes. So what did ETFs do? ETFs is kind of, we take that for granted today, but this is kind of how things work today when you buy an ETF is you buy something and on top is the NAV or the asset price or the share price of the share you just purchased, right? And as the value of the assets go up, the share price continues to go up. And you have the same number of shares. And when you sell at the end, you kind of owe all the taxes at the very end, right? And what's interesting is the taxes you owe at the end is the same across mutual funds and ETFs, except with an ETF, you haven't stayed current at the on your taxes. You just owe the whole thing in year 5. Whereas with a mutual fund, you've kind of paid it along the way, right? And so, it was kind of when ETFs first came about, it was very popular, sort of like saying that, hey, this is kind of like an interest-free loan from the IRS, right? You're sort of like, you're not having to pay your taxes every year. You're getting not paying any taxes until the very end. And if you kind of want to quantify the value of that interest-free loan from the IRS, it's about 4.4% of the cumulative benefit from investing in an ETF over a mutual fund over a course of 10 years, right? And this is a Goldman Sachs study from 2019. Because when you pay taxes early, you miss out on the value of reinvesting those tax payments that otherwise go to the IRS, right? And the kicker in this whole thing is, there's a step up in cost basis at death, right? And so when your cost basis is low, like an ETF, you're basically sort of like getting that free step up, or your beneficiaries are getting that entire step up in cost basis, basically without having paid the taxes like you did with a mutual fund. Okay, so this is kind of a quick few minute summary on ETFs versus mutual funds, right? So how does direct indexing play into this whole thing? How is it related? How does it, sort of like improve on the ETF advantage, right? So first, let's talk about the direct indexing basic mechanic, which is the way it works is instead of buying an ETF, like SPY is an ETF, right? It represents the S&P 500 index. You buy a share of that fund if you want to buy the S&P 500. And so instead of doing that, what you do is you kind of break down the index into its individual components. Like Apple is like X percentage points, Nvidia is that percentage points, Microsoft, Exxon, etc. You buy the stocks individually at the correct allocations, right? And then what happens is when a stock loses value and it visits its cost basis, let's say you bought something at $10, now it's trading at 7, right? You kind of see that opportunity and you harvest that loss. You sell that stock, you capture the loss of $100, right? And you temporarily exchange it and you buy something else that's correlated to the thing you just sold, right? And then you kind of come back into the original position and you do that over and over again, and you're just accumulating these tax losses. And think of them as you're investing, you're getting the same returns, as an ETF, but you're getting these tax losses. Think of them as, in a way, like an analogy that I like to consider is like a sort of like collecting credit card points or airline points or something like that. You're still going about your business, but you have these like side benefits that you're accruing and collecting, right? In this case, the side benefit is the tax losses. And then you can use these losses to offset a tax bill, right? Okay, so one of the key, I guess, motions in direct indexing is this tax loss harvesting motion, right? So let's sort of like dig into that for a minute and zoom into it and sort of like understand like how it works at the very basic levels, right? So with imagine Tesla was bought for $20,000 and you're not really doing any tax loss harvesting. You hold on to Tesla, it dips to 14,000. You're like, it's fine. I'm going to hold on to it. It's going to recover. It does actually recover and it goes up to 30,000. And then at the end of that journey, you basically sell Tesla. And so your cost basis is 20,000. You have you're selling it for 30,000. You have a $10,000 in gains and you owe taxes on $10,000. That's very basic, right? And so let's say a more advanced customer is doing some tax loss harvesting, right? So what they do is they buy Tesla for 20,000, it dips, and when it dips to 14,000, the customer kind of swaps out Tesla with another basket of stocks that's correlated to Tesla for 30 days. And then when Tesla goes back to $30,000, that's when they sell. So in this tax loss harvesting scenario, what's happening is your cost basis has been reset down to 14,000, right? And then, but your gains have gone up to 16,000. The difference between 14 and 30 is 16,000. But you've kind of accrued or accumulated the $6,000 in losses, right? And the key thing about tax loss harvesting is that you've used the $6,000 in losses in year 2 to offset some other gain outside of this whole Tesla thing. Maybe you had some other stock that had a gain in year 3, and then you can use the $6,000 to save money on your taxes against that sale of that stock, right? And so you've kind of, sort of like take it again, offset the tax bill, paid less in taxes, and gain a bit of an edge because of the tax savings, right? And imagine sort of like this motion happening over and over and over and over again on a large index like the S&P 500, for example, right? And so what can you expect to do? So the cool thing is, let's say the number to, I guess, keep in mind is 40%. You can harvest 40% of an investment back in capital losses. Just to make the numbers easy, say you invest $100,000, you can basically get $40,000 back in capital losses in basically tax deductions against capital gains. And the 40% happens over 10 years, but obviously it's not uniform. It's kind of front loaded, which is a good thing. You get most of the savings in the first 5 years. This graph just shows that you get 15% in the first year and then 8 in the second year and 7 and so on. So most of the savings are in the first 5 years, and then it kind of dies down from that because you've already escaped most of the stocks cost basis that you purchased at the beginning, right? So there aren't as many tax loss harvesting opportunities down the line. But so you get a total of 40%, and this is corroborated. This is a Vanguard study with the 40%, and this is a FRAC study on the, kind of how you expect to get the 40%, right? And so, okay, knowing all this, knowing that you harvest losses, how does direct indexing compare to a mutual fund and an ETF? And this is really, I find it really fascinating that, a mutual, like a direct index is basically like a polar opposite of a mutual fund when it comes to the tax advantage. With a mutual fund, you pay taxes every year. You stay current on your taxes every single year, right? Whereas with a direct index, you harvest losses every year. Not only do you're not paying a tax bill every year, you're actually collecting a tax credit every year, right? And sort of like you're collecting it. With an ETF, it's kind of neutral. You're not really paying taxes and you're not getting a tax advantage either. You're kind of just sitting there, without paying a tax bill or getting a credit, right? And that's kind of the orange thing. And so the fascinating thing about this whole thing is, again, like if you remember back to the Tesla example, you've kind of increased your cost basis. So you owe more in taxes because you decreased your cost basis. You pushed it down. So you owe more in taxes with a direct index that you can offset with the tax losses that you've harvested. But sort of like the 3 strategies, ETFs, mutual funds, and direct indexing, at the end of the day are kind of, you owe the same amount of money in taxes. But again, the advantage comes from using these losses early on, right? In year 1, it's, in year 1, you've harvested losses. And then you have these losses sitting there. You haven't sold your index yet. And then you have some like concentrated stock that you're trying to diversify. You use a loss to offset that tax bill. And then year two, you sold the house, you have a tax bill that you owe, you harvested losses, you use the losses against the house that you sold, and so on and so forth. There's a couple of really important points here, and maybe some misconceptions about cap losses in the US tax code. There's actually no limit to how much you can offset in cap gains with cap losses. There's a $3,000 amount that you can offset against ordinary income if you don't have any cap gains. Say like 1 year you have no cap gains at all, you can actually offset $3,000 of your normal like salary W-2 income with losses. But against cap gains, there's no limits. You can offset $1 million in cap losses with $1 million of cap gains. There's no problems with that. And then the other thing is, any unused capital losses in a certain year carry forward until you die, right? They just kind of they're accounted for, they carried forward year after year, and then they're used when an opportunity comes up with a cap gain, right? I should just pause here and just say that this product, direct indexing, is really appropriate for customers who expect to have capital gains. If you don't expect cap gains in your future, or if you sort of like, you have maybe a lot of cap losses from some other source, right, that you're carrying forward already, then this product is just not right for you, right? This product is really appropriate for folks who have cap gains, expect cap gains, maybe want to sell a house one day, maybe work in tech. There's stock that they invested as an RSU that has appreciated, they want to sell one day. Those types of scenarios are perfect for direct indexing, right? Okay, so oopsie, sorry, there's a little glitch here. Okay, so we did this. Okay, so why are people talking about direct indexing today? You may be hearing a bit more about it or reading more about it. We exist as a company because of this trend, and I would say that the strategy has existed for a long time. There's family offices that have been doing direct indexing since the 80s. And so this is not a new thing, but it's now become more mainstream because of three things that happen in the industry, right? The first one is we can buy fractional shares, right? We can buy $5 worth of a stock, which means you don't need $1 million to do a direct index. Now you need $20,000 to represent an index like an S&P 500 with low tracking error, right? And so the minimums have come down, so it's more approachable by more investors, right? The second thing is there's zero commission trading now. That has become more of the norm, right? So we buy and sell a lot of stocks when we direct index to keep you tracking the index closely. And if you had to pay a couple of dollars for every trade, it would make this strategy just absolutely not feasible, right? And then the third thing is the compute costs have come down. Like these optimizations to figure out the right trades for you are actually quite expensive, right? And so these three things have contributed to direct indexing now becoming a bit more accessible and more mainstream. All right, so I want to show you a quick demo of a direct indexing account, just so you get an idea of what, kind of what to expect in a direct index, how it works. And this is our startup. It's called Frac, and this is all we do. We do a direct indexing, sort of like a strategy. You pick the index, S&P 500 or anything else, and we direct indexing for you by buying the stocks and tax loss harvesting them, right? So this is a real account that was started on December 5th, 2023. You can access this on frac.com. There's a top menu that says how it works, live demo. And you'll see that, this $50,000 was invested. You can hover over this chart and you can see what you would have been at if you bought the ETF instead. We use SPY as a benchmark because it's the largest ETFs representing the S&P 500 by market cap, right? And you can see how there's actually two lines. There's a faint purple line and more of a bold purple line. And as of July 8th, yesterday, the S&P 500 direct index was worth 61,488. SPY was worth 61,223. So maybe there's a $250-ish difference between them. Now it just happens to be that the direct index is above by $250, but it could have been as likely below by $250 too, right? This tracking error can work in your favor or against you by about a maximum of 1% per year, right? But what you get, in exchange for that compromise on the tracking error is that you get tax losses, right? In this case, we harvested $1,761.54 in tax losses, even though the market has been going up. Obviously, if there's a correction that's coming up or something like that, we'd harvest a lot more losses. But in this case, we were able to harvest losses, even though the market has gone up 23% since this investment was made. And the estimated value of these tax savings for this customer is $868, and there was like $18 in fees paid. So you can see the amount of value that you accrue as a customer here is quite ginormous relative to the fees that are paid. And then you can see all the holdings over here. You can view all the positions, how far they are from their target allocation. And then you can also see all the activity that's happening, all the dividends paid, all the tax losses that are happening. In this case, the tax losses that were captured on July 5th was $5.72. It all adds up, of course. And it sold a bunch of stock and it bought a bunch of other stock, right? That's basically how a classic direct index works. And on FRAC, and we transparently show you all the tracking against the benchmark, the harvested losses, the performance, the fees, and all the activity. Okay, cool. So let's go back to just a couple more things, and then we can start taking some questions. There's two topics that always come up. This topic of a tracking error. What are the gotchas? Like, what am I giving up in order to get these tax savings, right? And the second thing is the fees, right? Like, obviously, any service provider like FRAC or others are charging fees. Are these fees worth it? At what point do they become sort of like not worth it, right? So tracking error. Tracking error, what happens is, back to that example of Tesla. Tesla went down, we sold it, we bought a basket of other stocks, and then we kind of waited 30 days to avoid the wash sale window. And then we sold that basket of stocks and we bought Tesla again. So tracking error happens because the basket of stocks that you buy, right, may not perfectly be correlated with the stock that you just sold. Right, so you may have sold Tesla, bought this basket, but this basket maybe slightly underperforms or slightly overperforms the target stock that you just like exited, right? And that's where tracking. And so you start accumulating these tracking error. In the case of the demo I just showed you, there was a $250 tracking error, but we just happened to be above the index by $250, right? And so there's multiple papers on this. We have our own paper on it. There's AQR has a paper on it. And you can expect the tax losses to be a maximum of 1%, right? With a 95% confidence interval. It's actually on average 0%, because for every time you tax loss harvest and you beat by a little bit, you tax loss harvest and you underperform by a little bit. So on average, you're at 0%, but you can expect a maximum of plus or minus 1% with a 95% confidence interval. And again, we want to emphasize that you have an equal chance of underperforming or overperforming the index every year by that amount, right? So that's kind of the deal with tracking error. We think it's kind of, not a big deal. It's sort of like a solved problem at this point, and it's sort of an acceptable risk. Yeah, it's, if you really just want to always be benchmarked to the ETF, maybe that's something for you to consider. But most people have not that much of an attachment to the benchmark, especially if it's a maximum of 1% per year, right? The second thing I would say is the fees. Now, on the fees part, we at FRAC, we are proud to be the cheapest provider, actually, of direct indexing in the market. And the reason we do that is because we think this product is unlocked by these cheaper fees, right? And let me sort of like just illustrate how this works. There's a few assumptions you need to believe. The first assumption is that you can actually harvest 40% of an investment back in losses, right? And I showed you that Vanguard paper initially. Well, you can, and what this means is if you invest 100,000, you can get 40,000 back in losses. If you invest $1 million, you can get 400,000 back in losses. You're gonna have to kind of take that as an assumption, right? By the way, some years, like if you harvest from the year 2008 to 2018, for example, you would have harvested a lot more than 40% because there was a 2008, 2009 crash. You would have harvested 80% of an investment, right? But 40% is kind of what you'd maybe on average expect, right? The second assumption you want to sort of like believe is that you have cap gains outside of your portfolio to offset, right? If you have no cap gains, again, what are the cap losses good for, right? You need to have the cap gains. So let's take this $1 million portfolio that's growing at maybe a 10% annual rate, and you're in a 30% blended tax rate, right? In a cap gains tax rate. Between state and federal, of course, if you live in California or New York or something like that, your blended tax rate is higher than that, and let's look at a 30-year horizon, right? So, and then let's see, this chart will plot the difference between the ETF price, which is kind of the closest competition to direct indexing, and a direct index. So if, let's say, the ETF price was 3 basis points, like VOO is 3 basis points, and the direct index price was 13 basis points, then that difference is 0.1, which is Freck's price point, right? Now, other platforms have a bigger difference between the ETF and the fees, right? Like Wealthfront has a 0.25, Fidelity charges a 0.4%. If you do direct indexing with a wealth advisor, you're paying a 0.75%. So let's look at what happens with Freck. With Freck, the value of the tax losses that you get when reinvested, the tax savings, right? You save on taxes. We take these savings, we put them back in the market, right? And we reinvest them and compound them over time is massive, right? You basically, for $1 million portfolio, you make another $1 million in 30 years, right? With a 0.1% expense ratio. As soon as you start increasing the prices, right, like if you go up to 0.25%, the value to the customer goes down a bit, but it's still decent, right? You still are making $250K over 30 years with a Wealthfront price point of 0.25, right? And then what happens with like more expensive price points, like a Fidelity at 0.4 or like a Wealth Advisor at 0.75, is actually that sort of like the value goes to zero in a number of years. So with Fidelity's case, right, in about 23 years, and with the wealth advisors with 11 or 12 years, right, you end up basically back to zero. Like you might as well have bought the ETF instead, by year 11 and 23, right? And so this is why we think it's very important to, pay attention to the fees, because you're getting most of the tax losses in the first 5 to 10 years of your portfolio. So that's where the value comes from, but you're committing to these fees for the long term. And as your portfolio grows, it's getting sort of like eroded away by these higher fees as it grows, right? And the tax benefits start to like underperform the value of the tax of the savings compounded, right? So again, this is sort of like why we're proud of the fact that we have the lowest fees in the market, and we think this is kind of the way you bring this product mainstream. Yeah, I think this is basically it for the main presentation, and happy to take any questions.
Thanks, Mo. So please sort of put some questions in the Q&A box. There's a few there already, and I'll sort of start to run through them. A couple came before you kind of went through or covered it in the presentation. Well, there's a question here that asks, what would be some advice as a good first step for a new investor? Sort of, I think they've been investing in stocks, so ETFs funds for 2 or 3 years, but never done anything quite so maybe wild, eccentric as this.
Yeah, I think if you basically have new cash, you have new earnings, new cash that you think of deploying in the market, and you've kind of come to peace with the fact that, okay, well, I'm not an active investor, I'm a passive investor. I'm gonna buy something like a total market cap or like an S&P 500 or something like that. Then you kind of have to make a choice between buying an ETF, which is the default that people think about, or maybe purchasing a direct index instead. And I would sort of like urge you to look into the direct index, because there may be some point in the future where you may need these capital losses to offset some cap gain. Again, I like the analogy of the credit card, because why pay for everything in cash when you can use a credit card and get the credit card points and one day get a discount on your travel or something like that, right? That's kind of the analogy here.
There's a question that you did cover, but I think it's quite important. So, in terms of slippage, how much slippage should someone expect versus the underlying proxy? I mean, you covered it, but just to sort of specify again, Dan.
Well, there's like maybe a couple of definitions on this, right? The first one is just simple tracking error from buying the replacement stocks, and those are well quantified. They're plus or minus 1%, right? There's another maybe definition. Maybe maybe this is what this member is asking is slippage in terms of the uh, transactions, because we do a lot of buying and selling of stocks, and there's obviously a bid-ask spread, right? And so there's a bit of a hidden cost there, right? And so we quantified that. We have a white paper on this actually, under our resources section, a white paper that's we can maybe drop into the comment section as well, that describes the impact of trading costs, right? And the TLDR is actually quite minimal, right? We do a lot of trading, but because we optimize the trading to happen at the close of the trading day, where the bid-ask spread is the tightest, and most of these stocks that we trade are highly liquid stocks, the transaction costs don't actually end up becoming meaningful at all. They amount to something like $100 over the course of the 10 years of trading a $50,000 direct index.
Questions come up about customizability. I'm sort of not sure if that's the word, but yeah, you get the picture. Yeah, how easy or difficult is it to customize according to your desires? It could be ESG related or whatever you're into or not into in terms of that.
Yeah, that's a great question. So specifically for ESG, you could just select an ESG index in the first place. And so, CRISP is the index provider that Vanguard uses. They've got a large cap CRISP index. We're going to offer that soon on FREC. And so you can just choose an index that is already tilted for ESG. But you could also choose just a classic S&P 500 and do your own things on it, right? You can do your own research. You can go and ask or do your own research and figure out like which are the biggest companies that are contributing to microplastic solution, just as an idea, right? And if you have these 7 companies that you want to exclude, you can go into the direct index and say, well, I want the S&P 500 minus these 7 companies, right? So you could add or remove companies from the S&P 500 or entire sectors, right? You can remove the entire financial sector, for example, if you're heavily invested there already.
And that won't really impact the cost or the tracking because in some way,
Well, what happens is once you edit an index, obviously your benchmark is still SPY, so it's kind of like muddies up the the direct indexing tax loss harvesting tracking error versus kind of what you've done, by editing the index. And so you don't get to see a clear picture of like, okay, is it tracking because of what I did, or was it because of the tax loss harvesting action?
question here, I'm not sure. It says, do you have a model you can share using dividend ETFs? I'm not quite sure whether that's your area or not. Yeah.
Yeah, no, that's a good question. Like dividend, like index, like maybe the member is asking about like an index that like a high dividend yield index or something like that, like an S&P 500 specifically that has only the high dividend payers, right? We're looking into that right now. It turns out that direct indexing works very well for most indices, but not all indices. Let me sort of like expand on that a little bit. If an index has a high turnover rate, meaning an index has a lot of companies that are leaving and joining it all the time, then that could cause cap gains to sort of like flow back to the customer, right? And so some of these, like value or growth tilt indices or potentially these high dividend paying indices, if they have a high turnover rate, they may not be a great fit for direct indexing. So we're still studying that. We haven't formed a proper opinion on it yet. But yeah, if we do determine that it's a good fit for direct indexing, it will be an option that we can find on FREC.
Okay, good. Yeah, you touched on some of the suitability, but what are the potential risks associated with direct indexing? Sort of, and is it something that you mitigate and look after, or is it that something, is it all in your hands once the money's kind of with FREC or invested with FREC?
Well, like sorry, what specifically?
Well, it's like the risk. What are the risks associated with direct investing? Yeah, is it if someone wants to pull their money out after they've invested with you, it's going to start to change anything, or is it like an ETF that you can take your and buy and sell it if you want to?
Oh, okay. Yeah, you can certainly withdraw from a direct index, and it's actually kind of uh, like tax advantage to do it relative to an ETF, because when you sell, let's say you're selling from a direct index, our optimizer, right, will choose the tax lots to sell that have the highest cost basis to you, right? So, you end up like, whereas with an ETF, you bought the ETF, a year ago at a certain price, right? Whereas with a direct index, you may actually be able to choose tax lots that have a higher cost basis that you're selling, such that they don't cost you as much, right, to sell. So you can, you're able to sell a portion of the direct index. It's just an optimization, right? You tell it, okay, well, please turn my direct index into this index, but with a $5,000 cash position, and it knows which things to sell to create the $5,000 tax position, cash position for you to withdraw.
Okay, good. For investors who are new to direct indexing, what steps are there? Is there regulatory sort of extra regulatory stuff that they have to do, or is it very straightforward?
It's quite straightforward. So on Frac, what you do is you create an account, and it's a brokerage account, right? It's a brokerage account. It's a margin brokerage account because we have a line of credit that you can use, by the way, to borrow against your direct index if you don't want to sell. Instead, you want to borrow, take a sort of like a secured line of credit against the stock. But it's a margin brokerage account, and it's in your name, and it's with a clearing house called Apex Clearing. And it's sort of like we're an introducing broker dealer, and Apex is the clearing and broker dealer. And they, by the way, they custody the assets of other big fintechs like Betterment, like Ally, like Webull, like SoFi, and others, right? And they basically hold the stock in your name, right? So we realize as a startup, some folks are always like, oh, well, what if you guys go out of business? Well, first of all, hopefully that never happens, knock on wood. We've got 5 years of runway. We raise money from very good investors like Greylock and others. But, in the hopefully unlikely case that we do go out of business, your assets are with Apex Clearing in your name. And you can, in fact, create an account with Apex and another one with Frac. And you can look at the Apex account gives you a view on your assets over there, right? And you can always kind of pull them back out into Fidelity or Schwab if you change your mind.
You touched on tax loss harvesting quite a bit, and do you just want to kind of maybe just go over that just a little bit, sort of again, sort of just the wash sale rule?
Yeah, sure. So what happens is with tax loss harvesting is let's say you own a stock and then it goes down in value, right? Uh, all tax loss harvesting is doing is it's booking that loss, right? Let's say you bought something for $10,000, it's now trading at 5,000. That same asset, right? So what you're doing is you're selling it, but once you sell it, right, the IRS doesn't let you buy it back instantly because that would be kind of, a big loophole, right? You can be selling and buying right away and collecting these losses all the time. So what the IRS does, it says, okay, well, you can sell it and book the loss, but in one condition, which is you have to wait 30 days to buy that thing back again. So this is kind of where the software comes in. It says, okay, well, we just sold this and booked the loss. What are we going to do for these 30 days? Obviously, you can sit in cash for 30 days. That would be a bad idea because the market moves and you're in cash, right? Um, or you can like buy something else, right? You can buy something else that's kind of it looks similar to the thing you just sold. Like, you just sold Google, maybe you buy Meta, and since both of them are in the same sector of the economy, they're going to kind of move together. So, there's all these risk models that exist now. MSCI has a risk model, the MSCI bar risk model. There's a bunch of other risk models that tell you, okay, what assets are correlated to what assets, right? So you kind of do your best when you sell something to buy something else for 30 days, such that when that 30-day window ends, you can sell it and buy back the original position. And hopefully kind of what you chose to buy and what you actually bought have like moved kind of in the same direction, right? So to minimize the tracking error.
Those companies would always be S&P 500 members if you're in the SPY equivalent, yeah?
Yeah, totally. So when we sell something, we buy something else that's also in the S&P 500. Yeah.
Okay, good. It's an exciting time, sort of. Where do you see the future of direct indexing sort of like going to?
Yeah, it's super. I mean, it's kind of it's exciting because it's been around for a while, but now is the kind of the moment where it's becoming a bit more mainstream. And so there's a bunch of things happening. First of all, like it's going to continue to become more, I think, accessible to more people. Meaning maybe the minimums will keep going down. There's going to be more selection. Like maybe some folks don't want the S&P 500. Maybe they want, I don't know, the Russell 3000. So hopefully you can easily choose an index, right, that you like, that you have a preference for. And then there's like some more advanced strategies that a lot of companies are working on, called like long short. So you can be, for example, 130 long, 30 short. So you're still, net 100% exposed to the market, right? And what that does is it kind of boosts the amount of tax losses you can harvest. So instead of harvesting 40%, you can now harvest 80%, right? And then who cares about that? People with concentrated stock positions. An NVIDIA employee with $20 million in stock, and they want to sell it and not pay 10 million bucks back in taxes, and they can sell it by a direct index and harvest, a lot more in tax losses than if they would have done the classic direct index. So, there's plenty of research papers coming out all the time and new strategies. And so it's an exciting time to be in the space.
I think we've just got time for one more question. So just about, typically, do the users usually, look after the tax benefits themselves, or I assume it's somewhat automated process, sort of generally, or with you?
Yeah, totally. It's a tax document that you get, like you'd get from any other brokerage, like a 1099-B. So you get this tax document. It has a summary field. We would have traded like maybe 100 times or more on an account, but you get and you get all these trades documented in that tax document. But there's a summary field that says, net long and net short term cap gains or losses, right? And your tax accountant or a tax software like TurboTax can just ingest that, and it goes into your sort of like your tax return. And that's sort of like, that's the extent of it, right? Yeah, so it should be quite seamless.
Okay, great. That's lovely, Mo. Thanks. Yeah, it's sort of all we've got time for today. Yeah. So thank you for joining us, everyone. I hope it's been enlightening and informative for all of you too. Please join us for the Modern Investor Summit on December the 3rd and 4th. It's a 2-day event with back-to-back sessions and workshops led by some of the biggest names in finance. So pre-register for your ticket using the link shared in the chat that we've just done. Mo, thank you very much again. Sort of an exciting time. I hope it all goes well for you. Thanks.
Thank you so much. Appreciate it.